Hi everyone, welcome back. So today we are going to work on our 13th set of paper. LCCI Level 3 Financial Accounting, December year 2018. So this is our 13th set. Okay, so you should, if you have been working with us on the previous paper, you must have noticed that we are working faster and faster. Okay, usually we just use below 2 hours to finish one paper. Okay, that's good. Okay, so let's start. 5 questions, 100 marks, all compulsory questions. Question 1. Question 1 is about other receivables and payables. Okay, you can see here we are given some information. Work on the agency commission account, general expenses, and then statement of profit and loss. Okay, so here we have some stakeholders and their interests. Okay, and we have to tell what financial statements, which financial statements they are interested in. Okay, so for the bank, for the ability to repay borrowings, okay, we can also learn from these interests. Okay, when later we are again asked what they are interested in when looking at the financial statements. Okay, we can copy these points. Okay, so for bank, they will look into the statement of financial position, okay, to see if you have enough assets to repay your liabilities. Customers, ability to maintain continuity of supply. Okay, this one, okay, it can also be the statement of financial position. Okay, because if it is in good financial health, okay, then most probably this company can continue to exist and continue to supply goods. Okay, it can also go into the notes, the explanatory notes. For the government to assess the correct tax liability, so they will look into the statement of profit and loss. Okay, how much they gain. Owners' ability to provide return for their investment. Again, statement of profit or loss. Okay, I'm a little bit disappointed that they are not asking about statement of changes in equity and statement of cash flows. Anyway, we have to prepare the following accounts. Okay, for the year ended 31st March year 2018. Okay, so let me see. Okay, yes, the year end is 31st March year 2018. Let me draw the account, the lines for the accounts first. Okay, we haven't read the information given yet, but I assume that agency commission is our income. Okay, and of course general expenses as the expense. Okay, let's see if I guess it correctly. So we have opening balance and closing balance, other receivables, agency commission. Okay, let's see. And also other payables, general expenses, one opening, one closing. Okay, bank summary, receipts, agency commission. Yes, this is receipts, so it is income for us. Okay, and then payment, 42,000 for general expenses. On 31st of July, 500 owing. Okay, so this is related to irrecoverable, okay, and nothing else. Okay, we can later calculate the depreciation, okay, or we can also calculate it now. 1,000. Okay, so we are also given the petty cash opening and closing balance. Okay, what do you think? Will it be related? No, I don't think so. Okay, because we don't have any receipts. Or should we? Oh yes, I think we will use this. Is it related? Let me see. Opening balance plus the receipts minus all the payments. Okay, no, it is not equal to that. Okay, because if you use opening balance and then you add the receipts minus the payment, okay, you will have 18450. Okay, if you further decrease, okay, then that means you have another payment of 18400. Let's see how we can use this. Okay, so it is not drawings, but what is it used? How is it used? Okay, anyway, okay, we prepare the agency commission account and the general expenses account first. Agency receipts 75450, and then you have opening other receivables 1450. Okay, this is easy because you don't even have to analyze the amount. 1450 other receivables, it must be in the debit side. Okay, opening balance year 2017, 1st of April. Okay, and then you receive 75450 year 2018, 31st of March. Okay, bank. Okay, you are not told about let me see, bank. Okay, one more item is because you have 500 not received. Okay, so irrecoverable debt here. Okay, this amount you haven't received, but then it is also part of your income. Okay, so you have 74500 as your income statement of profit or loss. Okay, you are not given any closing balance, so that's it. Next, general expenses. Okay, you have an opening balance. You don't have any opening balance. Okay, opening balance, no, nothing. Okay, other payables, general expenses, it is a closing balance 1550. Okay, 1550. Okay, and you have general expenses. General expenses payment 42,000. So here, year 2018, 31st of March. Okay, bank, a payment of 42,000. Okay, and then later you have an other payables closing balance of 1550. I will always write the balance brought down figure because the balance carry down figure is only the balancing item. Okay, so to make sure it is correct in the correct side, I will always use the balance brought down figure. Okay, so it will go into this side 1550. Okay, this is the balance carried down on the 31st of March, and here you have the transfer, okay, to the statement of profit or loss. $43550. Okay, so if you have to do some analysis of the balances, okay, this one, okay, receivable, income receivable, that is, okay, that is income in arrears. You should have received it last year, okay, but then it is not yet received. And for here, 1550, okay, closing balance, credit side, it is an accrual for you, accrued expenses. Okay, so next we are going to prepare the statement of profit or loss. Oops. Yeah. Okay, I am still concerned about the balance we have. Petty cash. Oh, okay, I see. Here, petty cash. This is petty cash. From the bank account to the petty cash, so we have to see opening balance. If we, work this out like an account, opening balance, we have 250. Okay, and then we receive money from the main cashier, and we have 1250 here, receipts, okay, from bank. Okay, and then closing balance, we have 50, and then after we balance, okay, 50 here, 1250 minus 50, we still have 1450. Okay, and that is payment from petty cash. Why do you pay out money from petty cash? Okay, it's because you have some expenses. Okay, we're not told what expense it is. Okay, so we can call it miscellaneous or sundry expenses. Let me update this. Okay, other receivables and payables. I always forget this part. Okay, I hope I remember. Okay, in our in this paper. Okay, so 1450, and then you have 500 as irrecoverable debt. Okay, depreciation 1000. Okay, so let us put in all these figures. Income being 74500. Okay, so revenue. Okay, this is service revenue. Okay, 74500 less. Okay, you have expenses. Okay, I like to write those can be easily forgotten. Okay, irrecoverable debts, depreciation. Okay, irrecoverable debts being 500, depreciation 1000 as calculated. Okay, we also have the general expenses we have calculated, and the sundry expenses, okay, or miscellaneous. Okay, 1450, and then general expenses, I forgot. Okay, it would be 43350. Okay, 43350. 46300 negative 28 1,000 4350. 500, 1000, 4350, 1450, 66500. Okay, done. Okay, this is profit for the year. State which accounting concept applies when writing off irrecoverable debt. Of course, it would be the prudence concept. Okay, next question. Okay, we have these items, and then of course the extended trial balance. Okay, state some errors, and then calculate closing inventory, calculate office expenses. Okay, and then extended trial balance. Okay, and then some more explanatory questions. Okay, let me update the question details first. Oops. Why? What happened? Okay. Okay. So, first thing, state two errors not identified by preparing a trial balance. Okay, error of commission, error of principal. Okay, or error of omission in full, error of reversal in full. Okay, something like that. Okay, we have to calculate closing inventory and office expenses, and in meantime we will work on each item. Okay, G provided the following information. In addition to the extended trial balance provided, disposal proceeds 3,500 from the sale of non-current asset have been recorded in the sales account. Okay. So 3,500 for disposal recorded in the sales account. Of course, we look at revenue, the sales. Okay, sales is in the credit side. If we want to take away this item, we debit it and then put back into the disposal account 3,500. Okay, this one done. Commission received of 2567 have been recorded correctly in the cash book, but recorded as 5267 in the commission received account. So we will use the suspense account as well. 5267 minus 2567. It is 2,700 overstated in the commission received account. Okay, overstated, then we have to take it away. Okay, so commission received is in the credit side because it is an income. So if we want to take it away, so debit it 2,700. Suspense. Okay, we might have to make some adjustment to the suspense account as well. Okay, let's see if it is needed. Okay, so next one, still nothing about inventory and office expense. Closing inventory did not include. Okay, here we go. It did not include. Okay, goods sent on sell or return basis with a sales value 6,000 and a cost of 4,500, okay, not confirmed by the customer. Okay, so for inventory, we only use the cost, okay, not the sales value. Okay, we are also not told about let's see, we are also not told about putting this in sales. Okay, we are not told. Okay, sometimes we will say that we have invoiced our customer, then we have to reduce it from sales and also reduce it from the trade receivable, but then here, no. So another item, this is addition. Another item, damaged goods costing 7,500 can be sold for 8,000 after repairs costing 1,000. Okay, so NRV is equal to 7,000, 8,000 minus 1,000. Okay, and then we compare, okay, damaged goods costing this one and can be sold. So this should be included. And closing inventory did not include. That means we simply add back. Okay, we are not going to, find the value of impairment. Okay, because for impairment adjustment, we have already included. Okay, and it is included in cost. That's why we have to reduce the cost. But then here we said it says the inventory did not include this amount. Okay, so 4,500 addition and 7,000 addition. Let's see. We have to calculate the closing inventory value. That means we also have to look at the balance given 23450. Okay, 23450. Okay, add 4,500, add 7,000. Okay, and this would be 11500 addition. Okay, I calculate this one because later we'll use this 11500 in our adjustment. Okay, so 23450 add 11500 for 34950. Okay, the addition is 11500. Let us put it into the statement of the extended trial balance. Okay, so statement of financial position debit and then statement of profit and loss credit. Okay, addition means it goes into the same side. 11500. Okay, so this one done. Next, office expense included rent of 12,000 for the year ended 31st December. Okay, our year end is on the 30th of September. Okay, and this rent goes beyond the year end. Okay, for how many months? For 3 months, October, November, December. Okay, these 3 months payment in advance. Okay, prepayment. Okay, 12,000 for 1 year. Okay, that means 1,000 for 1,000 for what? 1 month. Okay, we have prepaid 3,000. Okay, but then I am concerned because okay, it says office expenses included rent. Okay, we have to see if we have a separate item for rent. Okay, here no. Okay, so it means that it is okay to include in office expense. Okay, so office expense 29750. Okay, 29750. Okay, we have to adjust it. 29750. We have prepayment of 3,000, so minus 3,000. Okay, so 26750 for general expenses. This 3,000, let us adjust it. Office expense, debit side, if we want to reduce the amount, we credit it. Okay, and this prepayment goes into our other receivables item. Okay. Next. Okay, this one done. Insurance included 600 pay for G's home's insurance for the year ended 31st December year 2018. Okay, look at here, we have this year end. Okay, but then it doesn't matter because it is a drawing. Okay, 600 for private use. Okay, so we go to drawings, 600. Okay, and then also insurance. Okay, insurance is a debit account, so if we want to reduce it, it goes to the opposite side, credit. Okay, last item. Drawings of goods 135 have been recorded correctly in the drawings account good. Okay, but no other entries have been made. Drawings of goods, okay, will go into the purchases account as negative. Okay, so purchases is in the debit side. If we want to reduce, we credit. Okay, how much? 135, and then go into the suspense account as 135 because drawings account is correctly entered. Okay, so this part done, 12 marks. And then we go on to the remaining 2 marks. Explain why it is necessary to adjust the office expenses for the year ended. Okay, so this one again, we have worked on it for several times. Okay, so for me, I would always prefer to write about the accruals concept. Okay, the matching principle. Okay, why we have to adjust the office expense. Okay, if we include that amount, the prepayment expenses will be overstated. Okay, that means profit will be understated. Okay, it will not be correct. Okay, and if you have to continue to write, okay, you know, if you based on a profit or an expenses or a statement that is not accurate, that is not correct, then you might make you know, the incorrect decision. Okay, question 2 done. Now let's go to question 3. Okay, question 3 is about partnership. Okay, we always see, we can, you know, see the order of this question. Okay, usually question 1, okay, or sometimes question 2, it will be extended trial balance, and question 3 always partnership. Question 4 and 5 usually single entry. Okay, and then statement of cash flows. Okay, so 5 topics. Okay, you know, 4 topics are mostly fixed. Okay, and then 1 topic you can have sundry, you can have non-current asset, you can have a lot of different things. Okay, so let's see. Question 3. We have Rimpi and Hyen were in partnership, sharing profit and losses in ratio of 2:1. The partnership agreement also provide for interest on capital, 10% balances, 10% per annum on balances at 1st of October. Okay, I guess this is the opening date. Okay, 1st of October, and then salaries per annum for Hyen of 14,000. Opening balance of the 2 partners, capital account, current account. Okay, this time given to you, Hyen have a negative current account. Okay, using brackets. Okay, not telling you that it's a debit balance. Okay, but then the same. Okay, on the 1st of July, how many months through the year? Okay, I guess it is 9 months, but then we still have to count. Okay, so October, November, December, and then January, February, March, April, May, June. Yes, okay, we have to count. Okay, we always have to count. So 9 months. 9 months. Tay joined the partnership introducing 75,000 by check. This included a loan of 25,000 at 10% per annum, payable half yearly. Okay. Rimpi, Haiyan, and Tay agree to share profit and losses in the ratio of 2 to 2 to 1. The new partnership agreement also provided for interest on capital at 10% on balances at 1st of July. Okay, and salary for Haiyan and Tay, 12,000 per annum each. Goodwill valued at 60,000, not to maintain goodwill in the partnership books. And for the year ended 31st September, we have each partner, okay, having drawings of 16,000. Okay. Profit for the year, 72,000 accrued evenly. Okay, this time no revaluation of other asset, only goodwill. Okay, so we have to state one reason for not retaining goodwill in the books. Okay, so usually, okay, I will also give the accounting concept. Okay, for prudence concept, okay, and historical cost concept, historic cost concept. Okay, we are not paying anything for it. Okay, and for prudence concept, okay, we cannot reasonably and objectively determine the value of goodwill. Okay, that's why it should not be brought into the books. Okay, or okay, if we go in a simpler way, okay, because only purchased goodwill can be recorded. Okay, this is according to the accounting standards. Okay, only purchased goodwill. Just like if you purchase another company, you pay for more, then you quantify the amount of goodwill. Okay, but then here, okay, you just assume, okay, you just determine that goodwill is 60,000. Okay, so next we have to calculate the goodwill account. Year 2018, 1st of July. Okay, you have more goodwill, okay, because of the change in the partnership, 60,000, and then you have to write it off. Okay, so both items comes from capital. Okay, capital account of what are the names? Rimpi and Haiyan. Okay, so first of all, it is Rimpi and Haiyan. Okay, they are sharing profit and losses in the ratio of 2 to 1, so 40,000, 20,000. Okay, and then you do goodwill written off, you credit it because goodwill is an asset. So if you create, it is in the debit side. If you write off, it is in the credit side. Okay, so you have 3 partners. Okay, Rimpi, Haiyan, and Tay. Is it Tay? Tay? Let me see. Tay, yes. 2 to 2 to 1. Okay, so 12,000, 24, 24. Okay, so just add up, make sure it is correct. So next one, we have to prepare Hyan's capital account at 1st of July and balance the account on that day. Okay. Capital account is in the credit side. So addition is in the credit side. Okay, year 2017 first. Okay, of course we have to bring it from 1st of October. Is it October? Yes. Okay, opening balance. And we have to read from Hyan, right? 50,000. 50,000. Okay, 50,000. Okay, and then on 1st of January, no, 1st of July. Okay, what we have to do is we have to take care of goodwill adjustment. Okay, because there is nothing else apart from goodwill adjustment. So here we can see Hyan, the goodwill creation. We have 20,000 and then 24,000 for the goodwill written off. And we have goodwill again. Again with this, 50,000 plus 20,000 minus 24,000. After that, you will have 46,000 closing balance. Okay, the appropriations go into the current account, not capital account. Okay, so only goodwill adjustment. If you have revaluation of other asset, okay, it will be there as well. Balance brought down 2nd of July. Okay. Next. Okay, what is that? Calculate the interest on capital for each partner for the year ended. Okay. Okay. So let's see. Interest on capital 10% here for the first 9 months. Okay, applied to the capital accounts of the 2 original partners. Okay, but then remember it is for 9 months only. Okay, so 10,000 and 5,000. Let us calculate first. Okay, 10,000 multiply 100,000 for Rampy, 10% and then 9 months. Okay, 50,000, 10%, 9 months. Okay, so this one is equal to 7,500 and then 3750. Okay, so this is the first half of the year. Okay, second half we have already calculated that High-end will have capital of 46,000 and then 10%, 3 months. Okay, let us confirm. Yes, we have 10% as well. Okay, so oops, where? Okay, here. So 46,000, 10% for 3 months, 1150. Okay, how about Rempe? Rempe, how much for capital? Originally 100,000, and then 40,000 for the goodwill creation, 24,000 for the goodwill written off. Okay, again, just like High-end, only the adjustment of goodwill. 140, 24, so 116000. 116, 10%, 3 months. Okay, 2900. Okay, let us calculate the 2 first. Plus 10400, and then 4,900. Okay, how about for Tay? How much capital does he have? Okay, so you can see here, introducing 75,000 by check, but include 25,000 as loan. Okay, that is not capital. Okay, capital is only 50,000. Okay, and then 50,000 loan, and then further reduced by 12,000 for goodwill written off, 38,000 only. Okay, so 38,000 multiplied by 10% multiplied by 3 months. Okay, 950. Okay, that's 3 months only. Okay, so next, the appropriation account for the 3 partners. Okay, so this time you are not given a format. Okay, but then if you remember from our previous year, okay, we should separate it into 3 columns. Okay, or 2 if you prefer. Okay, we have total. Okay, we have for the first of October to 1st of July. We should also write the year maybe. 1st of October year 2018 to 30th June. Okay, it will be better. Year 2018, this is 17. Year 2017. Okay, and here we have 1st of July to 31st of September year 2018. Okay, so net profit. Let's see, profit for the year. Okay, 72,000 accrued evenly throughout the year. Okay, so let us put it there first. $72,000. Okay, 18,000 for the last quarter, and then 54,000 here. Okay. Appropriations. Okay, I always prefer to put salaries first. That is my own habit. Okay, for High-end and for Tay. Okay, so let us read from the question. Salary for high-end 14,000 per annum, and then salary for high-end and Tay 12,000 per annum. Okay, so high-end 14,000 for 9 months, it would be 10500. Okay, and nothing for Tay for the first 9 months. Okay, and then 12,000 for 1 quarter, 3,000 for high-end, 3,000 for Tay. Okay, and that would be 13500 and then 3,000. Okay, next one we have interest on capital. Okay, for the 3 partners, Rimpy, high-end, and Tay. Okay, we have already calculated. We have even, separate the first 9 months and the next and the last 3 months. Okay, that is good. Okay, you can see from our workings. Okay, so 7500, 3750, great, and then 2900, 1150. $950. Okay, total for Rimpy 104 4900 950. Great. Okay, and after this, we can calculate the profit available for distribution. Here, don't forget the negative sign. Okay, share of profit. Rimpy, high-end, and Tay. Okay, so for the first 9 months, it is 221, 32250, 10750, 21500. Okay, nothing for okay, and then for the next 3 months, 2 to 2 to 1. Okay, 7,000 divided by 5, 1,400, 2,800. Yes, 7,000. Yes. Okay, so it's done. 6 marks only, not much. Okay, but then it is not difficult either. Discuss whether the partners should continue as a partnership or convert to a private limited company. Okay, so we have to explain the pros and cons. First thing, of course, okay, to limited company, okay, it is good because you can have assets to more funds. Okay, because you have limited liability, okay, more people will be willing to invest in the company. Okay, and because it is audited for a limited company, the banks are more likely to borrow you, to lend you money. Okay, and as the owner, you can also enjoy limited liability protection. Okay, these are all good. And one more thing is, okay, if you further want to expand your company and want to later go public, okay, of course the first step is to become a private limited company first. Okay, but then also, how about if you want to stay and still be a partnership business? Okay, so the documentations and formalities are simple. Okay, you do not need to do any extra things. Okay, to do that, okay, keep it small. Okay, so that you keep control. Okay, you do not need to be audited. Okay, and do not need to pay extra costs because of that. Okay, for conclusion, I think, okay, it is important to see the future of the business. Okay, what you want it to be. Okay, if it is just a small business, a family business, okay, or a business with very close friend or short term, okay, then you keep it as partnership, keep it simple, just make the money and go. Okay, but then if you can see the business going larger and larger, okay, and you want to expand, you want to have more branches, okay, go international, then of course you can start to expand by making it a private limited company, and then of course later, if it is possible, okay, to be a public limited company in the future. Okay, so that's all for this question. This kind of evaluation is simple, okay, because it's basic. Okay, you should know it in your level 2 as well. Okay, so we have 2 more questions. Okay, let us scan through before we take a break. So next, you can see, okay, do not keep full accounting record. That means, again, it is single entry. Okay, prepare the statement of financial position. Okay, and then some explanation questions. And then for question 5, statement of cash flows. Okay, you can see year 2018 in the left hand side again. Okay, and here, oh, okay, yeah, statement of cash flows. Okay, some evaluation from the accounting ratios. Okay, prepare the statement of cash flows. Yes, the whole thing. Okay, and then evaluate the performance, 5 marks. Okay, so let's take a break. 10 minutes. Okay, see you soon. Okay, so let's continue. Okay, so I put sole trader as the question detail for this one, okay, because it worked on the statement of financial position. Okay, statement of financial position for 31st March year 2018. Okay, so let's see what is given to us. Okay, Hammer does not keep full accounting records but was able to provide the following for the year ended 31st March. Okay, on the 1st of April, at the 1st of April, that is year start, you are given the following: allowance for doubtful debt, cash at bank, cash in hand, inventory, okay, machinery, cost and accumulated depreciation, trade payables, trade receivables. Okay, and then bank summary. Okay, you have taken a 12% bank loan, trade receivables, admin expenses, drawings. Okay, and then machinery, trade payables. Okay, so you have to work out all the things. The first thing you can work out is the closing bank balance. Okay, so you have opening bank balance of 4,500 here. Okay, so what is the closing bank balance? Let us work out first. Plus 20,000 plus 268,745 minus all the payments. 5,191,375. Okay, so you have negative 2870. Let me calculate one more time. 45,000 yes. Okay, so next, total sales given to you is 207,000 including cash sales. That means credit sales 270,000 minus this one. Credit sales you have 267,600. Okay, so you have cash sales. Okay, that means cash in hand. Okay, 1250 plus 2400. Okay, let's see what you have paid. Okay, for from cash. Okay, we'll see later. Total purchases including cash purchases. So again, we use this to calculate credit purchases. Okay, credit purchases 186,370. Okay, you have cash purchases. Okay, there were no other cash receipt or payment. Okay, so you have cash receipts, cash sales and cash purchases. Okay, so 1250 plus 2,400 minus this one. You have cash 2020. Okay, let's continue. Goods were sold at a markup of 50%. Okay. So here, okay, if that is the case, you will be able to calculate your closing inventory. Okay, with drawings of goods. Okay, drawings of goods. Now drawings apart from the cash, drawings from the bank, you also have 2,500 as drawings. Okay, so here you have, let us work out the trading account. Okay, so here I write trading. These things you should work it in the workings area, but then I don't want to flip the page, so let us do it here. So you have revenue less cost of sales, opening inventory, purchases, less drawings, less closing inventory, then you have gross profit. Okay, 2,500 for no drawings on the goods. Oh, okay. Closing inventory was valued at a selling price of 30,000. Okay, why? Okay, let's see if we can do that as well. Okay, so if goods were sold at a markup of 50%, okay, that is closing inventory as selling price, it is 150%. Okay, and that would give you, okay, 20,000 for closing inventory. Let's see if we can do that. Okay, revenue 270,000. Okay, and if that is the case, you can calculate the amount of gross profit and cost of sales already. Okay, so 270,180,000 here. Okay. Minus 180 you have. Okay, so you can check this is 50% markup. Okay, opening inventory given to you 145,000. Okay, if it is 20,000 here, let's see if we can balance 20,000, and then purchases 188,000. 145,000 145 plus 188. Yes, it is equal. Okay, so if I were the one who set the paper, I won't give this item. Okay, why do I have to give it if you can calculate it using the trading account? Okay, depreciation charge given to you as 8,500. Okay, 8,500. Okay, let us see. Machinery, we have purchases 35,000, and then accumulated depreciation, you have 8,500 addition to it. Okay, so 85,000, and then 3,8,500. Okay, and then, okay, this would be the first three items of your statement of financial position. So the 12% bank loan was received on the 1st of July. It is repayable in 2 equal installments with interest on the 30th of June each year. Interest is calculated on the amount owing on the 1st of July. Okay, so our year end is 31st March year 2018. Okay, that is 9 months after the loan was borrowed. Okay, so 9 months interest. Okay, and 2 equal installments. The first one would be due on the 30th of June year 2018. That is 3 months after year end. Okay, so first thing, we calculate the amount of interest, 20,000, 12% for 9 months, interest being 1,800. Okay, and of the 20,000, 10,000 would be current liability, and the other one will be non-current. Okay, two more items to make. Okay, that is the trade receivables and trade payables. Trade receivables and trade payables, yes. Okay, so let me use green for these two items. Okay, it is not difficult. Okay, no irrecoverable debt. We have an allowance for doubtful debt, decreased by this. Okay, so allowance for doubtful debt minus 350, that is 1500. Okay, and trade receivables, you have opening balance, okay, addition, okay, and then you have receipts or payment, okay, and then closing balance. Okay, you have to calculate the closing balance. So for trade receivables, opening balance, you have 18500. Trade payables, opening balance 22750. Addition, you have credit sales and credit purchases, okay, given here 267600, 186370. Okay, and then for the receipts from trade receivables, 268745, and then trade payables payment 191375. Okay, and with this you will be able to calculate the closing balance for both. Okay, 185 plus 267600 minus 268745, 17355. Okay, and then 22750 plus 186370, 191375, 17745. Okay. Two balances are so close. 17355. 5519. Okay. Okay, so one concern, are we able to calculate the amount of net profit? Let us see. We have the trading account done. Okay, we have depreciation. We have this. We have, okay, 350 as positive. Because all payments are already here, I think we might be able to calculate directly. Let me see. Okay, if that is the case, 10300. No. Yes, no. Let me see. Admin expenses. Admin expenses 64740. 75040. 15310. Okay, so one more item. We have to calculate opening balance of capital, okay, using these balances. Okay, so allowance for double debt, yeah, this one, inventory, this one, trade payables. Okay, so let us see. 4,500 into 50145, 50,000 minus 30,000, 22750 plus 34150. Okay, so we have found all the things that we need for the preparation of statement of financial position. Okay, I like this kind of question because it's like just putting into the puzzle pieces to make the whole picture. Okay, so if let's see if we can balance this account. Okay, so statement of financial position. Oops, we have here. Okay, I like to give 3 columns. Okay, the first column being for the non-current asset. Okay, cost, accumulated depreciation, and then carrying value. Okay, so we have machinery, 85,000, and then 385. 85,000, 385. 46500. Okay, current assets, inventory, trade receivables, less allowance for double debts, and then we have the net amount. Okay, and then we don't have other receivables. Okay, and then we have cash. Okay, so inventory 20,000, receivables 17355, and then we have 1,500 for allowance for doubtful debt. 17355, 1500, 15855. Okay, cash. 2020. 2020. Okay. Total assets 20,000, 37875, 875 plus 375. Let me check again. Okay, next we have equity and liabilities. Okay, equity. Opening balance and profit for the year, less drawings, and then closing balance. opening balance 1434150, and then profit 15310. Okay, so opening 34150, 15310. How about drawings? Drawings. We have 5,000 plus 2,500. Okay, that is 7,500. Okay, with this, we will be able to find the closing balance. Okay, if you do not want to find the net profit, then you can, trace it back from the total liabilities and equity. Okay, you find closing balance first and then find profit. Okay, but then for me, if it is available to be found, I always find it. Okay, so that I can make sure when I balance this account, I get the things correct. Okay, so next one, liabilities part. Okay, we have non-current liability, 12% bank loan. Okay, 10,000 is for non-current, and then current liabilities. Okay, again, we have the 12% bank loan. Okay, or maybe I put it in the second item because I want to show trade payables, trade, and then other payables. Okay, that will give you trade and other payables, and then 12% bank loan, and then also the bank overdraft, and then total. Okay, so other payables, I remember is 1,800 for the interest accrual, and then the 12% bank loan, 10,000. Okay, so let's look at the trade payables 17745, and also the bank overdraft being 2870. Okay, so trade payables 17745, 2870 here. Okay, so let's see if we can balance it. 17745, 1800, 19545 plus 10,000 plus 2870, 32415 plus 10,000, 42415. 84365, 8436. What? Let me calculate again. Okay, maybe I just miscalculate. 34150, 15310. Yes, here. 750. 1. Here. I'm scared to death. Okay. $10 would be difficult to find because that might be a calculation mistake. That might be, writing mistake. Okay, so what happened? 41960. Hey, yo, 41960. 960 plus 42415. Okay, so 84375. Okay, done. Okay, last question. No, we still have things to do. State 2 reasons why an allowance for doubtful debt may decrease. Okay, so you decrease the percentage. Okay, second, the trade receivables balance decrease. Explain how Hammer should treat the purchase of a calculator. Okay, so if the calculator is not of a significant amount, okay, if it is immaterial, okay, according to the materiality concept, then it should be treated as an expense or a stationary expense. Okay. Okay, next we have the last question, statement of cash flows. Okay, remember we have the closing balance in the left hand side, be careful. Okay, so what we have to do is calculate the cost of land purchased during the year and then the statement of cash flows. Okay, land purchased. Okay, so let's start here. Okay, so we have bank and then bank loan. Okay, remember year end is in the left hand side, so 52500 to bank overdraft. Okay, no, yes, cash, there's cash. Okay, so 52500, 525, and then 1950. Okay, giving you 54450 opening balance, and then closing balance you have 14630. That means a decrease of 69080. Okay, so bank loan, there is a decrease of 150,000. That would be your financing activities negative, a repayment of bank loan. Okay, so next we have non-current asset. Let's skip it for now. And then inventory decreased by 5,000, so operating activities positive. Share premium, share capital, let's do it later. Okay, here again it is an increase, not a decrease, increase. Okay, so negative operating. Okay, and then 15,000 trade payables increase, positive. Trade receivables 10,000 increase, operating negative. What is our year end? Our year end is 30th of June. Okay, 30th of June. 1st of April, dividend of 0.25 per share was paid on all shares issued on that day. So opening balance of share capital 100,000, 0.25 per share. That is dividend of 25,000. On 1st of February, bonus issue. 1 ordinary shares for every 2 ordinary shares were made. Okay, most flexible form of the reserve. Okay, so share premium from share premium. Okay, here we don't have enough. 1 ordinary shares for every 2 shares held. Okay, that means here, let me use green. Okay, we should add 50,000. Okay, minus 20,000 here, and then from retained earnings, which is not shown here, minus 30,000. Okay, if you have to work on the statement of changes in equity, then we should show it there as well. Next, on the 1st of April, right issue. 1 ordinary shares for every 3 ordinary shares held at 1.2. Okay, so that means you are going to issue a further 50,000, but then this time it's at 1.2. 50,000 shares at 1.2. Okay, that is 60,000. Okay, 50,000 from ordinary shares, 1,000 from share premium. Okay, together you have 60,000. This is financing activities positive. Okay, next. On 15th of June, machinery costing 75 with carrying value 45 was sold at a profit of 2,000. There were no other disposal of non-current asset. Okay, so non-current asset carrying value, good. Okay, so here, okay, it costs 75,000. Okay, and the carrying value 48. Okay, you do not need it, but I show it anyway. 75 minus 48. Okay, you have 27 as the accumulated depreciation. It is sold at a profit of 2,000. That means you are receiving 50,000 for it. Okay, so investing activities, operating activities, negative. Okay, let us go back to the non-current assets part. Okay, be careful. Okay, don't mix up opening and closing balance. Okay, let me use orange for it. Okay, so opening balance 550. Okay, we have purchases that we don't know yet. Okay, and we have disposal of 48,000. Okay, and then we have depreciation. Okay, and then 565000. Okay, so next item, you will have information about disposal. I think land which is not depreciated was acquired during the year. All other non-current assets are depreciated at 20% per annum using reducing balance method. A full year depreciation is charged in the year of acquisition, not in the year of disposal. Okay, good. Land, because it's not depreciated, that's why the purchase, okay, won't affect. The purchases won't affect the depreciation. So we can use this to calculate depreciation. 550,000 minus 48,000. Okay, and then multiply by 20%. We can calculate depreciation. 550, 48, 100400. Okay, so we have 104 100,400. Okay, and if that's the case, 550 minus 48 minus this one. Okay, 550 minus 48 minus 163400. Okay, here you have operating activities, and then this is investing activities, negative. Okay. So you are asked to work on to give this one 163400. Okay, workings done already, so I'm not going to copy it. Okay, next you have to prepare the statement of cash flows. Okay, statement of cash flows. Let us start. Okay. Yes, here. We have found all the items already, so I think it will be fine. Okay. Okay, cash flows from operating activities. Okay, so we have from net profit for the year given to you. Okay, how much? 60920. 60920. Okay, add depreciation less gain on disposal. Okay, and then disposal 2000. Okay, depreciation 10400. 10400. 100400. Okay, this gain on disposal. Or increase. In inventory, in trade receivables, in trade payables. Okay, so let's see. Inventory 5,000, receivable 10,000, and then 15,000. Okay, so 5,000, 15,000. Okay, or 10,000, 10,000, 15,000. Okay, just net off the effect. Okay, so net cash from operating activities. Okay, next, cash flows from investing. Okay, we have two items. And yes, add proceeds from sale of machinery less acquisition of land and buildings. Okay, so proceeds, I remember, is 50,000, and then acquisition of land and buildings being 163,400. 163,400. Of course, it will be negative. 113,400. I don't know if we have enough space, that's why I'll try to save some. We should have enough. Okay, net cash used in investing activities. Okay, next, cash flows from financing activities. Okay, we have dividend paid, we have issue of shares, a right issue, we have repayment of debenture or bank loan, I forgot. Okay, later we see. Dividend 25,000, 60,000 for issue of shares. Okay, bank loan 150,000. Bank loan. Okay, 150,000. 25,000 for dividend, and then 60,000 here. Okay, so 115. Okay, that's why we have a very large decrease in cash and cash equivalent. Okay, so here we have net cash used in finally net decrease in cash and cash equivalent. Okay, let me be lazy for one time. Okay, so let's see, 159320. This is negative. Mm. 69,000. I don't recall this figure. Is it correct? Missing 80. Why? Okay. No, it is correct. Okay, I just miscopy it from my calculator. 139320, 113, 115. Yes, yes. Okay, so let me copy the remaining two figures. 54450. Okay, and then 1614630 negative. Okay, done. I almost finished the whole thing, but then again forget to change this. Okay, last part. Evaluation. Okay, and state two other ratios. Okay. So, let us take a look. Return on capital employed. Okay, for business X and Y. Okay, business Y is better. Assets turnover. Business X is better. Inventory turnover. And then quick ratio. Quick ratio. Okay. Planning to buy a new business. Okay, and we have to evaluate the performance. Okay, so these are two different things. Okay, let me do the conclusion later. Okay, but then let's focus on the evaluation first. We have three ticks for business X. Okay, because asset turnover, inventory turnover, and quick ratio is better. Okay, let us focus on three different parts. Okay, here the first one, second one, and then the third one. Okay, so the first thing is for business X, the asset turnover. That means it is making more revenue from the total asset that it has. Okay, also inventory turnover is of higher times. That means they are able to sell the goods quicker. Okay, so these two correspond to other in saying that business A is making faster sales and more sales. Okay, faster sales, more sales, good. Okay, the goods are coming and going faster. Okay, less inventory is held. Okay, good. Okay, but then, okay, making more sales and making faster sales doesn't mean that they are more profitable. Okay, here we have return on capital employed a total of 5% more than the other one. Okay, 15% versus 10%. 10% is a decent return. Okay, but 15%, good, better, right? Okay, so it means that okay, even though business X is able to make maybe more revenue, faster revenue, okay, quicker sales, but then they are not able to gain a good profit from these sales. Okay, maybe the goods itself are not as good as business Y. Okay, maybe they are not controlling their expenses well. Okay, so for me, the performance in profitability, of course, business Y is much better. Okay, on profitability. Okay, so the next thing is if we are looking for an investment opportunity, okay, which business we should invest in. Okay, then we don't just look at the profitability or the performance of the business, but the return on equity. I mean the return on your investment. Okay, so here business Y provide 15% return. Okay, if we are on, if we are hoping to gain more from this investment, we always look at our CE. We don't even really look at, for example, net profit percentage. Okay, because they might make a good net profit percentage. Okay, this is comparing the revenue with the profit. Okay, but then here we are looking at when we invest in the company, how much we get back, how much our return would be. So focus on the return on capital employed. Okay, so always there is different if you are managing a company. Okay, if you are inside a company, you manage it, of course ROC is important, but then the other profitability ratios, just like revenue, profit on revenue. Okay, this is of course important in the operations point of view. Okay, so next thing is the quick ratio. Here we have a very safe quick ratio for business X. Okay, maybe because they are selling the goods well. Okay, cash flow is maintained at a good level. Okay, 0.8 is a little bit worth concerning. Okay, but then not very dangerous. Okay, if you plan to invest in the company, you can also put some cash in it so that it can have money to repay the liabilities. Okay, or you can borrow a loan from the bank. Okay, versus if you have to use the bank overdraft. Okay, so worth concerning, but then overall speaking, I still think that for business Y it would be a better investment for you. Okay, so write points and then make the conclusion. Next, state two other ratios that could be used to evaluate the performance of X and Y. Okay, two other ratios. Then I can use net profit percentage. Okay, as a percentage of revenue. Okay, and I can also use current ratio. I can also use the trade receivables collection period to see if I can collect our debt easily or in time. Okay, so 22 marks for this question. So that's all for today. Okay, tomorrow we will work on I think we have November's paper. Let me check. Yes, tomorrow, year 2018 November's paper. Okay, our that would be our 14th set paper. Okay, we are coming closer to our target of 30 sets. Okay, so see you tomorrow.